Good morning, everyone.
Good morning.
Good morning.
I will just wait a few seconds to give a chance to all people register to join, and then we will start. I see the number of participants still growing, so yeah, just wait for a few seconds. Okay, I suggest we start. We've got 1 hour with many interesting topics in accounting. So thank you for joining this session, this coffee chat session jointly and kindly provided by ILA. My name is Stéphane Schirrecker. I'm a partner at Deloitte in the Accounting and Reporting Advisory Department. I'm here together with Jérémy Page, who is also partners in this department for Deloitte. This is a department where we focus accounting advisory services to clients. And I'm here today to make a session that is around accounting and specifically relevant accounting topics for you as a board member. And the agenda will be the following.
Yeah, we have just some poll
Yeah,
question before the agenda, but I can jump here. Yeah.
yeah, maybe I can start. Yeah. So I will go through the recent Lux GAAP developments. And then Jeremy will jump into two poll question to animate the start of the debate, and we'll go through IFRS and key financial reporting focus that came from the regulators, and together we will cover the last section, being the consideration for you directors for the oversight on the financial information. There is a Q&A playing here, but if you have any questions, do not hesitate to post them in the chat, and we will take them in consideration at the end of the presentation. So, Jeremy, if you want to jump into the poll.
Yeah, thank you, Stéphane. Just before we start the session, so we saw just few poll questions for you to see how you can be aware, about what is happening, currently so on the market and how it can affect potentially so the financial information. So, just if you can share, please, your view on the first poll question that you have on the screen. So which word best describe how 2026 feels so far for markets? Okay. So here, do you see, I hope you see the results. If not, so let me comment. So the vast majority of you so answer so B, so uncertain, and A on volatile. So indeed, there is no, let's say, a right or wrong answer here because it depends definitely. So your situation. A few of you, for instance, answer opportunity rich. Indeed, what can be uncertain for some of you can be an opportunity for other. But we will see as well how is it important to still for the 2025 financial statement to speak about 2026 when it is about to consider, the effect of the subsequent event on the financial information.
Yes, and indeed, the answer to this being A and B mainly reinforce the message we will pass over this presentation, being very clear on what you provide in terms of disclosure in your annual accounts. Notably, of course, in line with the going concern issue, but also with the way you make your assessment, impairment, and so on, specifically for the time being. And what you answered right now is just in line with what we feel in the air so far from us.
Yeah. We can go to the second question. So the second question, so which of the following aspects of financial reporting do you think was in the focus of recent regulator publications? So if I'm looking at the first result and so of the poll, you answer so all of the above, so E, and as well so with a strong focus for a lot of you on fair value and impairment. So once again, so the correct answer is E, indeed, all of the above, but depends of your specific situation. Generally speaking, the focus of the regulators that they emphasize strongly for this year, it's on accounting estimate and judgmental area. That is a strong focus. And so we'll discuss in the slides about that and what is the specific, let's say, expectation from the regulator in that respect. Thank you for having participated so via the poll. So now we can start so directly so with let's say the first topic with Stéphane, so on the key recent Lux GAAP development.
Thanks, Jeremy. So just to give you a bit of context, I am also a member of the board of the CNC, so the Commission des normes comptables, and a member of the OEC, or des experts comptables. So the idea here is that I will give you a bit of an update what happens currently in terms of Lux GAAP. Of course, I'll try to be quite transparent, but there are things that I can say, some that I cannot, because there is not always an official agenda. But I will be happy to answer the question you may have at the end. In terms of Lux GAAP, I will go through the CNC guidance that have been provided in 25. There have been 2 Q&A provided in 25. And I will go through an update on the accounting law, because I know it's a hot topic, the project of the new accounting law that has been released in 23. And I will go through it and explain where we stand so far on this project of the law. Okay. So in terms of the first Q&A, so this Q&A is about Pillar 2. And if you remember, in 24, there was already guidance provided by the sensei in terms of Pillar 2 to clarify what would be the required disclosure in terms of annual account. But those Q&A in 24 focused on specific year-end financial statement, whereby this Q&A now is providing more generic guidance in the case where your company is captured by Pillar 2 or not. So this is not meant to be specific to a specific year-end. This Q&A has been elaborated to make sure that it addresses all the annual accounts. It was at the end for 24, but going forward, of course. So basically, the takeaway of this Q&A is to say that the management is still responsible for assessing if any additional information is required in the disclosure, in the annex of the account. If you have an assessment that Pillar 2 taxes is not significant, typically you will not expect extra disclosure in the annual accounts that is beyond what you usually provide for income taxes, again under Lux GAAP. However, if you have an assessment that basically Pillar 2 are significant, so the impacts of the Pillar 2 requirement provide with significant and material amount in your balance sheet or P&L, you need to provide supplementary information. And this is just in line with the true and fair view requirement. So basically, in other words, there is no automatic one-size-fits-all disclosure templates. You as a board member, you as a manager, you need to define, is Pillar 2 relevant to your group and your company? How material it is, and what level of explanation you need to put from a quantitative and qualitative information. It's quite generic. I think the guidance here is not going deeper. It gives the responsibility to the management, no surprise. But clearly, if Pillar 2 is significant to your organization, your group, your company, the expectation of the regulator, expectation from the auditor is that you put something on the account. Okay. On the next Q&A that was released end of last year, which is probably the most important one, of course, for 25. This is the what is usually named as the private equity exemption. So, of course, this Q&A is particularly relevant for the alternative markets. The main point here was to replace a very old Q&A that was issued in 2009 because it became obsolete in the view of the recent development that happened in the accounting law and in the laws in general in Luxembourg. So the CNC decided to revamp that old Q&A, widely spread in terms of practice in the alternative market in Luxembourg, and to replace it by this new Q&A that has been released in December. So the idea was for the scope of the exemption to be clarified and extended. As you can see, the previous Q&A mainly focused on private equity and venture capital, whereby now the scope has been extended to the whole alternative sector. So in principle, the consolidation exemption can be applicable to any kind of alternative structure you may have, whereby it relates to real estate, infra, private equity, etc. So there is no limitation that we used to have in the previous private equity exemption, which is not now a private equity exemption name, because of course we should call it otherwise, because it applies now more broadly to the alternative market. Here, a strong warning made by the Q&A is no cherry picking. What does it mean? If you apply a console exemption on particular shares that you want to exempt from the consolidation because you believe that those shares are held only for subsequent resale, then you need to apply that to all the shares for which you have invested for subsequent resale. So no cherry picking, you consolidate one entity, not the other. That's not the purpose. Okay, so the idea is to make sure that you apply this consolidation exemption on a prudence basis, and of course being consistent in your policy. This Q&A is applicable to all companies and parent entities for which the annual account have not been yet filed. If we go deeper on the condition to apply this exemption, on the next slide. So when you look at this, there is no big bang compared to the previous Q&A. I've seen some article in some paper, I've seen some comments, but overall, I can tell you the market, at least what we received as part of feedback, did not react such as it's a big bang, massive change. No. It provides clarification, it provides a broader scope, but in a way, the conditions are more or less the same as what we used to see in practice in the alternative market. It provides a bit of clarification, but when you look at all the conditions we've got here, there is no big bang. Investor profile is basically same condition that what we want to expect in the new Q&A. It's basically to ensure that we talk about a fund, we talk about an alternative structure where we've got investor averti being a definition that you can see in the CCAR law. This is broadly enlarged to other alternative market, but basically the idea is that The structure is made to invest in entities where you expect a return. So there is clearly aim of investment consideration here. So it's not shares that you held for operational purposes, for example. Okay, it's really to resell it and to make return about it. No change in the spirit between the old Q&A doctrine and the new one. As I said, broader purposes, because we now enlarge to the alternative assets in general. In terms of documentation, because this is basically where we probably had most of the question, and this is probably where an auditor would challenge the most the management, you as a manager, making sure that you have the appropriate documentation from the acquisition date to make sure that what you have invested in is for subsequent resale with a view to exit at one day to make a return. Good news is that the Q&A says the view, at least the period of holding has been extended. In the past, the old Q&A was mentioning a period of 5-7 years of detention to substantiate the fact that it's only held for resale purposes. Now, the new Q&A goes up to 10 years, but never exceeding 15 years. What's the reason about it? The debate at the Sensei was to say if you have shares in an investment that you have for more than 15 years, it's difficult to argument that at the end of the day, it's invested for subsequent resale. I mean, if you have a company coming in Luxembourg investing in an airport, I mean, saying that you do not consolidate that operation is a bit aggressive, okay? So the idea was to say, okay, subsequent resales mean a certain period of time. We are okay to extend that period of detention to say you are still in a subsequent resale spirit, but not more than 10 years. And in case of force majeure, 15 years. What could be force majeure? You have invested in an asset in Ukraine that was made for subsequent resale, but war is happening and you are not able to sell it. So, of course, we may understand that your period of detention is a bit increasing, but not because you do not respect the initial exit strategy, but just because you have a force majeure. Like now it could happen in Iran or wherever in that area. Okay. In terms of other conditions to benefit from the exemption, so fair value and disclosure, there is no change. Again, the idea is that if you want to apply this consolidation exemption, the fair value disclosure is still a must-have in the account. The good news is that, and I make a jump here to the cascade structure, if you have a structure with different holdco in cascade, you may benefit from the exemption from an entity to another, assuming that all the obligations are respected at the top co mother level. That's basically the spirit of it. So in a way, if you have an alternative structure beyond the fund that has 2, 3, 4 holdco, the idea is that you use the same paragraph to exempt the company to prepare a consolidation, and you indicate here that all the obligations in terms of fair value disclosure, etc., are kept at the level of the mother entity, the ultimate mother entity. Okay. So again, I know this one has created a bit of not noise, but discussion, even at different Big Four level. But when you look in details, it's a good sign for the market because it provided a bigger scope in terms of exemption. It just clarifies a bit some condition, but at the end, it's not a big bang in terms of practice. As far as, of course, you have made good practice about it in the past. Because, of course, if you have been quite aggressive in the past on the P exemption from the previous Q&A, and then the new one provide a bit of additional guidance and clarification. If you have been a bit aggressive, maybe you need to revamp a bit your documentation or other thing. But in a way, there is no big bang. Again, sorry to say that again, but clearly, my message is to make sure that you understand that it's not a game changer if you have applied it in your private equity structure until now. So that was for the Q&A, the Sensei. Just before we jump on the new accounting law, what could be the next topic at the Sensei? Again, I'm part of it, but I have no official agenda to share. There's different topics discussed on the market, different topics such as the crypto and how do we account for it in Lux GAAP. This is in the air, specifically with the new regulation that has popped up recently from the CSSF. But you have also topics around operation made in foreign currency. You have topics around restructuring, such as merger and the accounting treatment under Lux GAAP. As I said, there is no agenda. Probably things will come in 26, but you need to know that the sensei is working quite closely with the OEC or the expert comptable to define the right topic to address. So the next topic being the new accounting law. So I know this one is it's something that is expected and something that has produced lots of debates and questions. So just to step back a bit, in 23, the Ministry of Justice and government decided to modernize the accounting law that is derived from the law of 2002. And they have released this project of law in July 23 with the purpose to modernize the current accounting law, regrouping all the accounting provisions that are currently spread in different texts. Today, if you want to know about the accounting gap, accounting laws in Luxembourg, you need to dig in Code of Commerce, in the commercial law, in the accounting law, etc. So the idea of this project of law was to regroup everything in a single Bible, basically. And of course, beside this aim to bring a bit of simplification and clarification on the accounting law, the project brought also different new topics that we have referred here from 1 to 10 in the circle here. I will not go into details here because the idea, I'm sure some of you have already received lots of information about exactly what remains, what is new in this law and all the topic, but I will concentrate my focus here on the what are still the topic in discussion so far in the law and where we stand. First, where we stand. This law has been commented by many regulatory bodies in Luxembourg, the Barreau, OEC, CNC, etc. So this has been done between 23 and now. So the law is still in debate. I can tell you that at the CNC or OEC level, we are still in contact with the Ministry of Justice to talk about certain articles of the law, to rewrite certain articles of the law, etc. So there are still topics in debate, and I will come to those topics just later. But just for you to understand the agenda. When can we expect this law to be released? So I think and we believe that probably the government will first focus on the omnibus package. So omnibus package has been released by the European Union in February this year. The omnibus package is about simplification of the sustainability requirement. You have all heard about the CSRD disclosure requirement for big groups that came from EU and that was transposed in Lux. But the omnibus package that was released by the European Union in February provides simplification on those disclosure requirements. And what we believe is that the government and the ministry here in Luxembourg, Ministry of Justice, will first transpose this law before to go back to this accounting law. So what is the takeaway here? Probably the omnibus package will be a focus from the government during probably spring or summer. This is the Bill of Law 8370 that you can find into the Chamber of Deputies. So 8370 is the Bill of Law that will be linked to the project Omnibus. Once this will be done, we believe we may expect that they will go back to the accounting law here and they will probably release a new version, an amended version, during probably September, October. Again, what I'm telling you here is not an official agenda. This is what we may expect according to the experience we have on the way the government is working. And the big interrogation is what will remain in this law? And then we can jump to the next slide. Because currently, hot topics that are discussed at the level of the Sensei or say law are the one in red. But if I focus on the two or three main items, audit for large holding. So this one has created lots of discussion in new accounting law. Just remember what was the initial idea of the government was to say, we want an audit on large holding. In many cases, holdco are not audited because they don't have employee, they don't have turnover, so they are not reaching the criteria for audit. But we've got big holdco in Luxembourg. This is one key activity in Luxembourg, as you may imagine, that are not audited, but they've got millions, not to say billions of assets. So criteria was to say we want to audit them for those who have a total balance sheet of 500 million. Okay, but you can imagine on the market, bad reaction, lots of holdco, lots of auditor to find. So basically, this has been highly debated, commented by all the regulatory bodies, all the business as well. And this is still a discussion. Why this is still a discussion today? Because today the law is not giving a clear definition on what is a holding. It may be obvious for some of us, but that's not. How we should define a holdco based on what you have in the balance sheet, based on the nature of the revenue, based on the corporate object, it's not clear. So we, Sensei or say, have discussed a lot with the definition of what could be added in the law to define exactly what is a holdco. Again, remember, a holdco could be also a company making commercial activity. So again, what you should do in that case. So first, one key topic discussed a lot with the government. The second hot topic about this holding, the audit obligation. What about holdco in cascade? Do you want to audit 5 holdco in cascade and bring a standalone audit on each entity? This is an absolute nightmare, an absolute admin burden that most of the ones who recognize themselves in such structure want to avoid, which we understand. This has been also highly commented and provided to the government to try finding a way to escape from such obligation, but keeping the same spirit that the law wanted, at least keeping one audit obligation at a certain level. Question is, at which level do we put that obligation? Is it at a level where we've got a top co or a mid co or a finco who has a bank covenant, etc.? That's still in discussion with the government. Okay, that's still what we propose. I voluntarily focused on this one because I know it's one of the biggest topic of this new accounting law. There are many others that I cannot comment here because we've got only 1 hour, and Jeremy has lots of topics to cover. But what the takeaway for you is that new accounting law probably during by the end of the year. What will remain in the law, we don't know yet. Honestly, we don't know what the government will decide, but usually what they do in practice, they follow the Council of State. The Council of State has commented the law last year. They are aligned with some recommendations we've made. They are not going in all those details we have tried to go until now, but what I can tell you, I encourage you to read the Council of State. It's available at the Chamber of the Deputy, and you will have the link in the slide deck. And if you read the Council of State, probably you will have a flavor of what the government will follow in the future, because this is usually what they do. They follow the Council of State, they don't take risk, and if they amend the law, they will go that route. So that's my takeaway here about the new accounting law. Expect something by the end of the year. Read the Council of State to have a flavor of what could be amended, and probably effective date of the new law will be for audit, not before 28, I would say. They will not probably provide some requirement for 26. Okay, so it's a lot of information. The deck will be, I see here in the chat a question. Normally, the deck will be available afterwards, but that's the takeaway to take into account for the new accounting law. Jérémy, I leave you the floor.
Thank you, Stéphane. So after this focus also on Lux GAAP, let's see together the key IFRS development that are relevant for Luxembourg. So I will start with the good news, meaning that there has not been, a big bang in terms of new IFRS that enter into force in 2025. However, so there is a kind of a big bang for the coming years, so on the IFRS. And so that is why, so I will guide you through IFRS 18, IFRS 19, which are two new standards, and as well, so some clarification and updates related to the financial instruments. So on IFRS 18, so I just would like to give you an overview about the standards. So this is a new standard, so that has been endorsed by EFRAG. So that standard will come to replace, the existing standard IAS 1 for the presentation of the financial statements. And that standard, so it's applicable for the financial year, so starting 1st of January 2027. Okay. However, because it has been endorsed by EFRAG, so if you want to apply it early, that is possible, so meaning for the 2026 period. So it is a kind of a big bang, not in terms of recognition and measurement, because nothing changed in that respect. But what changed is a way to present the profit and loss statement. Okay, that is the first big change. Because for now, if you read IAS 1, so there is no clear, let's say, guidance about how to present, the balance sheet and the profit and loss accounts. So the big issue with that is the fact that you cannot really compare two entities from the same sector because some entity have a different presentation than another one. And so, for instance, it is difficult to really have, for instance, the profit coming from operational activity being different from the profit or losses coming from other type of activities of the company. So that is why there is a change in the structure of the profit and loss account, and I will enter into the detail just on the next slide. Second change is the fact that the IFRSs introduce the concept of management-defined performance measure, so-called MPM. So MPM, there will be a slide on which I will deep dive, but long story short, it is a KPI that you are communicating to investor. If those KPI are meeting the definition mentioned under IFRS 18, then you will need as well to disclose those KPI in your financial statement with a specific disclosure to reconcile the KPI with the profit and loss account. The third and not the least new requirement, it's about aggregation and disaggregation of the information. So again, here in a nutshell, it is to require to disaggregate the information at a level that is enough for an user of the financial statement to understand the financial line item. And second things on the aggregation is the fact you can aggregate element on one financial line item. You can aggregate elements that are sharing common risk characteristics. You cannot normally aggregate elements that do not have the same characteristics. And so this is the end, of just a boilerplate financial line item like other asset, other liability, other income, other expense. So you will need to be much more precise on the content of those expense, income, assets, and liabilities. If I am going a bit in the detail of the first significant change, meaning the change in the structure of the profit and loss, basically the new profit and loss account income will be structured in the same manner than the cash flow statements. It will be splitted in 3 categories. The first category will be the operating activity. Then you will have the profit and loss coming from the investing activity. And at the bottom, you will have the profit and loss coming from the financing activity of the company. And just before arriving at the net profit or loss, so you will have income tax and as well, so the profit or loss from discontinued operation. So that being said, even if the presentation looks like the cash flow statement, unfortunately, the definition, of each of the category, operating, investing, and financing category, is not exactly the same than the cash flow statements. So pay attention when you are making the analysis. Do not believe that it is a copy-paste of the cash flow statement and that you should follow exactly the same. There are some differences to consider. For the operating activities, so this is all the income and expense that are coming from the main business activities of the entity. And as you can imagine, a main business activity can be different, from one entity to another, first. And secondly, when you have a group, okay, and you are doing consolidated financial statement, you may have different type of business activities that you are consolidating. So this is why the definition of the main business activities is the first starting point when you are implementing IFRS 18 and should be done carefully. Also, operating activity, it's a residual category, meaning it is everything that is not investing and financing. Investing category, so this is all the income and expense that you derive from your investments. Okay. However, if investing it is your main business activity, everything that is investments, okay, and income and expense related from investment will be going to the operating activity. Except there is one big exception that is mentioned in the standard. If you have income and expense derived from investment in associate or joint venture that are measured at the equity method, that it is mandatory, no matter what your main business activity, it will be mandatory to go to investing category. However, keep in mind that if investing it is your main business activity, you have an option to account for investment in associate and joint venture at fair value. And in that case, then the fair value change will go to the operating category. The last category, so the financing, basically it is, we say, okay, income, but it's more expense, from your liabilities. Okay, so you raise loans in order then to purchase an asset, but then so the expense coming from that loans is an expense that needs to be allocated to the financing category. Okay. As well, if you have some leases, okay, and for which you account under IFRS 16, but then so the expense derived from the lease liability in the form of interest will go to the financing activity. So so that is a new way to present the profit and loss account, and that requires a specific gap analysis in order to achieve the proper classification to the profit and loss. Just one word, on the timeline for implementing the standard. So generally, what we are observing on the market is that generally, entities, so for the biggest group, let's say they started already in summer 2025, but for, let's say, the other type of entity, let's say they are starting, at least the gap analysis around Q1 2026, Q2 2026. Why so early? Is because I mentioned it is applicable for the first first time is the financial year 2027, but pay attention, you will need to have the comparative information as well. And the comparative information 2026 will need to be restated in order to fit with this new presentation. So that is why it is recommended to start already in 2026, to come already in 2026 with a kind of parallel run between the two standards, and so to start 2027 with already the new mapping in place. Because there are some difficulties that here does not appear, but when you will go into the detail, you may have some, like for instance, the classification of the foreign exchange related to each category of income and expense that will need to be allocated. Then on the MPMs, so the MPMs, so are KPIs that meet the definition under IFRS, so meaning it is so a KPI that is communicated publicly, that is a subtotal of income and expense that is not already defined by IFRS elsewhere. If it is the case, but then you have to have a disclosure that reconcile that KPI with the income statements. And you need to explain why this KPI is important for the stakeholders. Another key standard, so it's IFRS 19. So IFRS 19, long story short, it's applicable for subsidiary who has a parent that is doing a consolidated financial statement under IFRS. If you are in that case, the subsidiary can do IFRS financial statement, but with lighter disclosure. And when I say lighter disclosure, sometimes the disclosure are decreased by 60 to 70% in comparison to the usual IFRS. However, the standard does not apply if you are a subsidiary with public accountability. So meaning that if you are a bank, if you are an insurance, or if you are a fund, meaning because you have either equity or debt traded on the public market, or because you hold assets in a kind of fiduciary capacity. Last but not least, so under the IFRS updates, so that I would like to cover with you, it's about the classification of financial instrument. So I will let you to deep dive, but long story short, they came to clarify the requirement in case you invest in ESG assets. Because as you know, you have to perform the SPPI test, meaning the contractual cash flow test, to determine the classification of asset under IFRS. And then they come to say, when you have ESG feature, and for instance, the income related to that asset is derived from the achievement of ESG KPI, to determine whether or not it meets the SPPI criterion, you need to assess whether this achievement of ESG KPI is linked to the credit risk of the underlying entity. If it is the case, then it will meet the condition of the contractual cash flow test. Otherwise, it will not, and your asset will need to be measured at fair value. That clarification is applicable from 2026. Now that we have seen the IFRS and give you a view on the IFRS's development, we thought it was important as well to guide you through the key focus from the regulator over the financial reporting. We made a table that is coming from, and maybe you saw, an ESMEA paper, and as well relayed by the CSSF publication on what is the regulator priorities when they are looking at the financial statement. It is published on a yearly basis. And so if you look at the trend, long story short, they focus a lot on accounting policies, accounting estimate, and judgments. And so for 2025, if we look into the detail of that, but basically, what are the key attention points when we look at the volatile and uncertain environment? We all agree on that during the poll question. But then the key focus of the regulator, it is on the fair value and impairment, credit risk, and impairment, liquidity, because so you may have grant loans that have some covenant, or you have been granted loan with some covenant, so pay attention to the breaches. The deferred tax, especially if you are recognizing deferred tax asset, because as you know, you can recognize deferred tax asset only if you expect to make profit in the futures. And then, so all the disclosure and transparency of how your company is affected by the current so market condition. And I say currently, but as well, so pay attention to the subsequent event, meaning the today's environment and the disclosure you need to have in your account in that respect. So pay attention to this focus area because the regulator will look specifically at that if he's looking at your disclosure in the financial statements.
Yeah, and if I may add, of course, here it's focused on regulated entities, but don't believe that non-regulated entities should not follow the same discipline. Because even though non-regulated entities are not supervised by any body, you still have to work with the administration des contributions directes, with the auditors, with the market. So markets and those parties that I just said, they will expect the same level of disclosure, the same discipline, the same quality in the non-regulated entities whereby you have a small entity, SPV, Holdco, whatever. So I really encourage you to go through those elements because they may be also pertinent to you, structured that are
Yeah. No, indeed, it's not only IFRS, indeed. For your information as well, and I encourage you to read. So the CSSF published, its result of its inspection on the disclosure, of some selected public issuer. And so the CSSF made a report. So as you can see, the focus and the main point highlighted by the CSSF, it is some deficiency in terms of presentation of the financial statement, meaning non-respect of the way so the balance sheet profit and loss account needs to be presented. Disclosure related to impairment of asset and on financial instrument and fair value. So that are the top three elements to pay attention to. Okay, so this year, so pay attention, so accounting estimate, accounting policy, judgmental area, and how does it impact your financial statement, meaning your figures, but as well on the disclosure aspect, especially on the subsequent event.
And again, here, if I may add just one thing, Jeremy, again, do not underestimate the same for non-regulated entities. We've got example where, for example, boards or groups, they consult the CNC, they consult the OOC, or even sometimes they ask for derogation. It happens. For those who know, you may ask for derogation to publish US GAAP Conso. It happens. Those organizations will look at the quality of your reportings in the RCS, even though you are not regulated. So that's why I'm saying you can leverage from those commands issued by the CSSF or whoever regulated bodies to make sure that you are in line with what is expected by the administration. I mean, big A in the administration in Luxembourg for your entities as well.
Definitely. And I think you made a good transition because you mentioned the auditor, Stéphane. And so in this last section, consideration for director for oversight of the financial information. So we would like to start with you, on your role, as director during the audit. So here what we represent on that slide, it's among other, all the interaction time you will have or you may have with your auditor. Okay, and the purpose is not to be very complete on that, but to mention at least so those areas. So the first areas, okay, this is everything relating to, the discussion on fraud, okay, in the audit of the financial statement. So it is the responsibility of the auditor, okay, to perform some work, but as well, it's linked to the operation, the responsibility, you know, of the directors and the management in that respect, to ensure that there is an appropriate control environment, so to avoid fraud and to confirm to the auditor that you did not detect any fraud and that you have implemented so a robust environment for that. So that is the first point, and as you may know, fraud. So there is a fraud, so in different aspects, and one of each, okay, it is fraud related to the financial reporting, meaning that you would change the figure so in a fraudulent manner. And the second category of fraud, so it's a misappropriation of assets. The second communication area, you know, there is a standard where the auditor and you so need to communicate frequently about the major point of the audit. And some of the major point of the audit can be, let's say, allocated into various aspects. One aspect is the communication related to the deficiency in the internal control. And another aspect, this is the communication, you know, of the misstatement identified during the audit. And obviously, so the directors so remain responsible for the preparation of the financial statement, and so to have a robust internal control environment to enable so an accurate financial information to be provided in the reporting. And so that is why so there is the notion of the internal control and the notion about the misstatement and the evaluation of the misstatement by the management and the directors in order to correct it. You can challenge the auditor as well about the materiality threshold that they are applying. Okay, because at the end, you need as well to be comfortable with the financial reporting. Subsequent event, this is something as well that you may discuss with your auditor, the disclosure, what you identified, and especially, you know, your auditor at the end of the audit will ask you, you know, to sign a representation letter. So a representation letter, so you need to confirm to your auditor, so several aspects that you discussed during the audits, and especially to confirm element on fraud, to confirm element on the subsequent event, to confirm so key documentation you provide your auditor with to ensure that the financial reporting so it's accurate. And for those of you who may act, you know, as a board of director for a bank or for a regulated entity, then as well there is so the communication around the key audit matter. The key audit matter are the key points for the auditor that will be disclosed in the opinion report of the auditor, in which he will mention that are the significant risk around the entity and the type of procedure he performs. So based on that, so here we just recommend, if I can say so, it's more, you know, for brainstorming, some key question that you can ask to your management in order to challenge, you know, and to make sure that financial statements are accurate or at least are taken in a good hands. So here, so you have some question that are given for illustrative purposes. So for instance, you can challenge the management on how it determines, you know, the significant estimate and assumption in the fair value measurement. To discuss with the management as well if there were some area of disagreement in that respect that has been discussed with the auditor. How the current geopolitical and macroeconomic environment has been considered by the management when making the assumptions for impairment test, for fair value, so for credit risk assessment. You can as well challenge your management team, meaning when you have the composition of the management team, did you verify that you have all the, let's say, adequate skills or resources, you know, at the management level? Are they trained with the last updates? Are they aware about, you know, what is happening and how to consider that in the financial information? You can challenge your current accounting policies, meaning maybe your accounting policies are no longer accurate or are no longer enable you to reflect the true and fair view of the financial performance, okay, of your company, and maybe to revise, to update might be needed. You may as well have discussion with your management about what we mentioned with Stéphane, the key recent Lux GAAP and IFRS development and how your management is tackling that. Okay, so this is just so illustrative example, for you to engage discussion with management, but as well you can engage discussion with auditor to challenge them on the procedures they perform. I make pause here. So we are about the end of the session. So I don't know, Stéphane, if you have something to add, maybe on those questions.
No. I think those questions are quite widely used and spread, so no specific comment. Of course, when you are audited, also you may have questions that are very specific that is coming from the auditor. But
Yeah.
no, nothing to add at this stage.
So maybe we can take then the few minutes we have to discuss some questions we received.
Yeah, we received a question on the classification for land and building. I provided with the guidance of the sensei. Toki, I think that's you provided the question. Sorry, I cannot answer to your specific question regarding your specific case, as you may understand. But I hope that you have access to this guidance that is freely available at the Sensei website.
Yeah, I will go through the guidance. Thanks for the tips. Thank you.
You're welcome.
Okay. Is there any other question, Stéphane, that is mentioned? I know you mentioned about the slides, and yes, the slides will be provided.
Mm-hmm.
Is there any other question?
I know I don't see something else in the chat. Unless someone has any question, we can close the session.